In the business world, it's dog eat dog, and you need every bit of competitive edge you can possibly get. Whether you're a salesperson, an entrepreneur, a small business owner, or corporate executive, you've landed on the podcast that gives you that edge and more. This is the Business Coach Unplugged Podcast. Exploring the strategies, tactics, and mindset shifts needed to elevate your business and leadership skills to new heights. Your host has walked the walk. He's coached thousands of clients to remarkable results and rubbed shoulders with legends like Tony Robbins, Ken Blanchard, Jack Canfield, and Brian Tracy. It's practical advice, inspiring stories, and the occasional dose of tough love, helping you to overcome challenges and seize opportunities. This is the Business Coach Unplugged Podcast. And now your host, owner of Potential in Motion, coaching you to the edge of what's possible, Tom Kelly.
Welcome to the Business Coach Unplugged Podcast. I'm your host, Tom Kelly. It's great to have you with me today. Today's episode is all about a topic that doesn't always get the spotlight it deserves, but it can make a huge difference for business owners, especially those who are just starting out or thinking about how to structure their business for maximum tax advantage and long-term success. We're talking about the specific tax benefits of using a subchapter S corporation, or what most people simply call an S-Corp. If you've been wondering about how to save on taxes legally, protect your personal assets, and position your business for growth, then this episode is for you. I know taxes aren't the sexiest topic to talk about, but trust me, understanding this can save you thousands or even tens of thousands of dollars every year and set you up with a business structure that works for you, not against you. Before we dive into the details, let's frame this conversation with why your choice of business and entity matters. When you start a business, whether it's a side hustle, a consulting practice, a tech startup, or a retail store, one of the first big decisions you make is, how do I structure this? Sole proprietorship, LLC, corporation, S corporation. Each has its pros and cons, but the tax implications can be huge. Many new business owners default to sole proprietorship or a standard LLC, which is fine in some cases, but sometimes people miss out on the tax advantages that an S-Corp can offer. This is especially true as your business grows and starts generating consistent profits. Just as an example, one of my clients, let's call her Sarah, owns a consulting firm. When we first started working together, she was operating as a single-member LLC, paying self-employment taxes on every dollar she earned. After reviewing her numbers with her accountant and talking through the options, she converted her business to an S-Corp. That change alone saved her over $15,000 in self-employment taxes in the first year. That money went right back into marketing and growing her business. So what exactly is an S corporation? An S corporation is a specific tax status that you elect with the IRS, available to eligible corporations and LLCs. The biggest distinction of an S corporation is how it handles taxes. It allows your business income, losses, deductions, and credits to pass through directly to your personal tax return. This is called pass-through taxation. That's different from a traditional C corporation, which is taxed twice, once at the corporate level when the company earns income, and again at the individual level when dividends are paid to shareholders. This double taxation can be a real drain on profits. By contrast, an S corporation avoids double taxation. You report the business income on your personal tax return, and you pay tax only once at your individual income tax rate. This is a huge advantage. It's one of the primary reasons many business owners choose S corporation status. Let's break down the key benefits that every business owner should know. Benefit number one, avoiding double taxation. This is the headline benefit and the most important one. With an S corporation, the business itself does not pay federal income tax. Instead, profits and losses pass through directly to shareholders' personal tax returns. This avoids the corporate tax and then the personal tax on dividends. For example, if your business earns $200,000 in profit, that entire amount is reported on your personal tax return. You pay tax once, not twice. This is different from a C corporation, where the business pays corporate income tax on profits, which is currently about 21%, and then if you distribute profits to yourself as dividends, you pay tax again on that dividend income at your personal rate. Benefit number two is a reduced self-employment tax, which is a huge savings opportunity. This is where things get interesting and can really save you big money. If you're a sole proprietor or an LLC taxed as a sole proprietorship, You pay self-employment taxes, Social Security and Medicare, on all your business earnings. That's roughly 15.3% up to a certain income limit. But as an S corporation owner employee, you pay yourself a reasonable salary and you pay payroll taxes on that salary. However, any remaining profits you distribute to yourself as dividends are not subject to self-employment taxes. So here's a quick example. Let's say your business makes $150,000. You pay yourself a salary of $80,000. You pay payroll taxes on that amount. The remaining $70,000 can be taken as distributions, which are not subject to self-employment taxes. That $70,000 saved 15.3% in taxes, roughly $10,700 in tax savings. The key here is you must pay yourself what's considered a reasonable salary, not a token amount. The IRS is watching for abuse, so be sure your salary matches industry standards for the work that you perform. Benefit number 3 is deductible business expenses. S corporations can deduct ordinary and necessary business expenses just like any other business. Things like salaries, including your employees, benefits, rent, marketing costs, travel expenses, office supplies, and so on. This reduces your taxable income and can help you keep more money in your pocket. A lesser known but valuable deduction is the employee expense reimbursement under an accountable plan. This means the S-Corp can reimburse employees, including shareholder employees, for legitimate business expenses like travel, meals, and equipment, without counting that reimbursement as taxable income to the employee. The corporation deducts these expenses, lowering taxable income. This is really important, especially if you own a business and work from home. For example, if you need a high-speed internet connection for your business, you can deduct that as a business expense, and it moves that expense from one that you paid out of your after-tax income to one that you can now deduct as a business expense. Since these type of expenses can add up quickly, this will help you reduce your taxes and keep more of your money in your pocket. Benefit number 4 is retirement planning benefits. One of the often overlooked but massive benefits of operating your business as an S corporation is the ability to leverage powerful retirement plans that can significantly reduce your taxable income while helping you build personal wealth and secure a financial future. Let's dive deep into this because retirement planning isn't just about saving for someday, it's also a strategic tax move that every savvy business owner should master. So there are 3 types of retirement plans available to S corporations. The first is the SEP IRA, which stands for Simplified Employee Pension Individual Retirement Account. The second is a solo 401k, also called an individual 401k or individual K. And the third one is a simple IRA, which is a savings and incentive match plan for employees. Each has its own rules, contribution limits, and advantages, but they all share the ability to lower your taxable income and grow your retirement savings tax deferred. So how much can you contribute under each program? With the SEP IRA, you can contribute up to 25% of your compensation, up to a maximum of $70,000 for 2025. This is a business contribution only, meaning you don't contribute from your personal paycheck directly, but the business contributes on your behalf. Contributions are tax deductible for the business, which reduces taxable income at the corporate level, or pass-through level for an S corporation. You must contribute equally for all eligible employees if you have any, which is something to plan for if you have a staff. For the solo 401k, this also allows you to contribute both as an employee and an employer, which creates higher potential contribution limits. As an employee, you can defer up to $23,500 in 2025 or $31,000 if you're over 50 as a catch-up contribution. As the employer, you can contribute up to 25% of your compensation. The combined limit for employee deferrals and employer contributions is $70,000 for the year 2025 or $81,000 if you're over 50 years old. Contributions reduce your taxable income and the plan grows tax deferred until retirement. And you can also choose Roth contributions for the employee deferral portion, which grow tax-free but don't reduce current taxable income. And finally, we have the simple IRA, which allows employee deferrals up to $16,500 in 2025, plus an additional $3,500 catch-up if you're over 50. Employers must make either a matching contribution up to 3% of compensation or a 2% non-elective contribution for each eligible employee, and lower contribution limits than the SEP and solo 401k, but this is much simpler to administer. So how does this create tax savings for you? The money for your S corporation contributes to your retirement plan, reduces the business's taxable income, which means your reported profits on your personal return, the pass-through income, decrease. For example, let's say your S-Corp made $150,000 in profits before retirement contributions. You decide to contribute $30,000 into your solo 401k as employer contributions. Your pass-through income is now $120,000 instead of $150,000, which lowers your income tax and potentially your self-employment tax base. Not only that, but because these contributions go into a tax-advantaged account, your money grows tax-deferred or tax-free in the case of Roth options until you retire. This is free money growth that compounds year over year. So what does the company match? When your S corporations makes contributions, it's essentially matching your personal effort by investing in your future. This is especially relevant if you have employees. With the solo 401k, you as the employer can contribute up to 25% of your salary on top of your employee deferral. This employer contribution acts like a match and is 100% deductible for the business. For businesses with employees, many use a simple IRA plan which requires employer matching, so understanding this match requirement is key. For example, if your salary is $100,000 and you defer $20,000 in employee contribution, your company could add another $25,000 as an employer contribution, reducing your taxable income significantly. So what's the big picture here? As an S corporation owner, you pay yourself a salary, and those wages are where your retirement contributions are based on. The ability to contribute both as an employee and employer means you can stash away a lot more than if you were simply contributing as an individual. The more you contribute, the less taxable income you have today, which lowers your current year tax bill. Over time, that's a powerful strategy, which can reduce your tax liability every year, help you build a retirement nest egg that you control, keep money growing without annual taxes eating into your gains, and allow you more freedom of options in your future. So let's do a real-world example. Let's say you have a successful consulting business as an S corporation, and this year you made $200,000. You paid yourself a reasonable salary of $100,000, which saved you $15,300 in payroll taxes. Then you max out your solo 401k contributions, both employee deferral and employer match, and you're able to invest $48,500 tax-free for your retirement. This also reduces your pass-through income from $100,000 to $51,500, which is paid at your personal individual income tax rate. Let's assume that your marginal tax rate is 22%. That means you save another $10,670 for a total of $25,970 in tax savings. As you can see by this example, this is a total game changer when it comes to keeping more money in your pocket. Here are some pro tips for maximizing retirement savings in an S corporation. Number one, work closely with a CPA to determine what reasonable salary is so you can maximize your retirement contributions based on that salary. Consider opening a solo 401k if you're a sole owner or have no employees for higher contribution limits and flexibility. Use a SEP IRA if you want simplicity and a pure employer contribution plan. Set a schedule to review and adjust your salary and contributions annually. Your business income and goals will evolve over time. And don't overlook catch-up contributions if you're over 50. These extra savings are designed to help you accelerate your retirement plan. In summary, retirement planning through an S corporation is a huge win-win. It's a win for your business because you get to deduct the contributions, lowering your taxable income, and you pay fewer taxes today, freeing up cash flow. And it's a win for you personally because you build a tax-advantaged retirement nest egg and you gain financial security and peace of mind for the future. If you want to set your business and personal finances up for long-term success, retirement planning through your S corporation is one of the smartest moves you can make. Benefit number 5 is the qualified business income deduction. The Tax Cuts and Jobs Act introduced a new deduction that's a game changer for pass-through businesses like S corporations. The qualified business income deduction allows eligible taxpayers to deduct up to 20% of their qualified business income. The rules can be complex and there are limits based on income and type of business, but the bottom line is that this deduction can significantly reduce your taxable income. Benefit number 6 is deductible health insurance premiums. S corporations can pay for health insurance premiums on behalf of shareholder employees and deduct these premiums as wages, lowering corporate taxable income. The shareholder employee then includes the premiums in their gross income, but can often deduct these premiums on their personal return, especially if self-employed. This is a way to get the benefit of a health insurance paid pre-tax, which can mean substantial tax savings. You might be asking the question, Tom, this all sounds great, but does an S Corp right for my business? Great question. There are some important eligibility requirements and considerations. Your business must be a domestic corporation or LLC. You can have no more than 100 shareholders. All shareholders must be U.S. citizens or resident aliens. You can only have one class of stock. Certain businesses, like some financial institutions, insurance companies, and domestic international sales corporations, are ineligible. But beyond eligibility, the S-corporation structure makes the most sense when your business is generating enough profit that the self-employment tax savings on distributions outweighs the cost and administrative complexity of maintaining an S-corporation. Which brings us to the administrative side of running an S-corporation. One thing I always stress with my clients, the S-corp isn't a set-it-and-forget-it solution. It requires careful record keeping, payroll processing, and tax filing. You have to pay yourself a reasonable salary through payroll with all appropriate withholdings and filings. You have to file an IRS Form 1120-S annually. You have to keep good accounting and documentation for distributions. And you have to maintain a clear separation between personal and business finances. If you're not already working with a qualified CPA or tax advisor familiar with S-corporations, this is the time to find one. Having a great tax professional is critical to making sure you stay compliant and maximize your benefits. So some common mistakes and how to avoid them. I want to share a few common pitfalls I see business owners stumble over with S-corporations so you don't have to. Number one, not paying a reasonable salary. This is the number one IRS red flag. If you pay yourself too little salary just to avoid payroll taxes, you risk audits and penalties. Mixing personal and business funds. You've got to keep your finances separate. This is vital for legal protection and clean accounting. Neglecting payroll compliance. Payroll taxes and filings are mandatory. Don't try to skip this. Thinking S-corp status reduces income tax. It doesn't reduce your income tax rate. It's about avoiding double taxation and reducing self-employment taxes. And trying to do it yourself on everything. Many business owners try to handle S-corporation paperwork and payroll themselves and end up making costly mistakes. So if you're ready to take advantage of the S-corporation benefits, here's a simple roadmap. Number one, consult with a tax CPA or tax advisor to see if it makes sense for your business. Number two, if you have an existing business, file Form 2553 with the IRS to select S-corp status, typically within 2 months and 15 days of the start of the tax year if you want it effective. Set up payroll to pay yourself and any employees a reasonable salary. Keep detailed records and maintain compliance. And monitor your business profits regularly to ensure you're maximizing benefits and meeting requirements. So just to recap, there are 6 main tax benefits of an S-corporation. Benefit number one, avoiding double taxation. The S-corporation allows you to avoid being double taxed by passing your income through onto your personal income tax and avoiding the corporate tax. Benefit number two is reduced self-employment tax. The S-corporation allows you to only have to pay the 15.3% employment tax on the reasonable salary that you pay yourself instead of the entire amount you made, saving thousands in taxes. Benefit number three is deductible business expenses. The S-corporation allows you to write off your business expenses against your income, which reduces your overall tax burden. Benefit number four is the retirement planning benefits. The S-corporation provides 3 different ways for you to save large amounts of money for retirement, which allows you to avoid taxes and grow your income tax-free. Benefit number 5 is the qualified business income deduction. If you're set up as an S-corporation, the tax law allows you to write off up to 20% of your qualified income, which reduces your overall tax burden. And finally, benefit number 6 is your ability to deduct health insurance premiums. As an S-corporation, you can deduct your health insurance premiums, massively reducing the amount of money you have to pay for your health insurance benefits. Choosing the right business structure is one of the most important decisions you make as a business owner. The S-corporation offers powerful tax advantages that can save you money, increase your cash flow, and provide a solid foundation for growth, but only if you understand how it works and stay compliant. If you think the S-Corp might be right for you, take the time to talk to a qualified CPA and put a plan in place. The right advice and careful planning will pay dividends for years to come. If you found today's episode useful, don't forget you can access a number of free resources on my website at www.businesscoachchicago.com. Also, feel free to connect with me on LinkedIn. I love connecting with listeners and business owners who want to grow and thrive. Thank you again for listening. If you enjoyed this podcast, please click subscribe, leave a review, and share it with your friends and colleagues. I'm Tom Kelly, and until next time, keep building your business and keep moving forward. Have a great week.
You've been listening to the Business Coach Unplugged Podcast. On this highly useful podcast for people in the business world, you get the absolute top-notch info from an absolute pro on how to elevate your business and your leadership skills. Tom Kelly owns Potential in Motion, coaching you to the edge of what's possible. He's also a professional speaker and leadership trainer. He's worked with some of the biggest names in the coaching business: Tony Robbins, Ken Blanchard, Jack Canfield, Brian Tracy. To sign up for a complimentary coaching session and to access some great free resources, hit the website at businesscoachchicago.com. Your success is not just a possibility, it's a certainty. See you next time on the Business Coach Unplugged Podcast.